How you doing? My name is Jamie, and I'm the founder of Milledge Insurance Agency. We're a national insurance brokerage. I'm the insurance broker to the CEOs, Average Joes, Jacksons, Genelese, Chow's, Mohammeds. I guess you get the point. We do not discriminate here. Our job is just to assist our clients. Today, I'm going to show you how to read your basic homeowners policy as well as your basic rental property policy. The written on form is called an HO3 form, also sometimes known as a DP3 form policy for your rental property, but there's many different forms. Those are just kind of your basics. So let's get into it. First, we have what's called coverage A. This is your dwelling coverage. In this example, it's at $500,000. Essentially, what your dwelling coverage is your building. That's your actual structure. Next, we have what's called coverage B. This is also known as other structures. And in this example, it's at $50,000. On most basic homeowners policies is 10% of your dwelling coverage. Now, for a rental property policy, you don't have to have 10% of your dwelling coverage. A lot of times they give you the leeway to take it on or take it off, depending on the insurance carrier. Next, we have what's called coverage C. This is your personal property coverage. This is at $250,000 for personal contents. To give you an example of that, if I take your home and I flip it upside down and shake it, everything that falls out, that's your personal property. That's your personal contents. Now, you may be saying, hey, Jay, well, I still have things inside my home that doesn't fall out, like my cabinets things. That's part of your dwelling coverage. So that would be here. Anything that's attached to your home is part of your dwelling. Anything that falls out for personal contents is your personal property. Next, we have what's called coverage D. For a homeowner's policy, it's called loss of use coverage. This is an event that, let's say you had a fire, a hurricane, one of your covered perils, you're not able to live there. This will go towards you live in the hotel until it's rebuilt. And this example is at $50,000. For a rental property, you also may see it called loss of rent, fair rental value, depending on the insurance carrier. And this is an event that your tenants aren't able to live there from a covered peril. This will go pay towards that. Next, we have this called coverage E. This is your liability insurance. This is at $300,000 in this example. To be honest with you, it doesn't cost that much more to go up to $500,000 for liability. Something to definitely take a look at. When you speak to our insurance brokers, we can definitely assist you and see what meets your needs there. Next, we have what's called coverage F. This is for medical payments. This is for little minor injuries. If anything's more than that, then your liability will kick in. And your liability, again, is going to protect you in the event that someone slips, falls, injures themselves, and tries to sue you. Next, we have this called all perils, DED. That's deductible. In this example, is at $1,000. We have here, if you notice in red, it's called hurricane deductible. That's at 1%. That's 1% of the dwelling coverage, and that's at $5,000. Depending on if you live in a coastal state such as Florida, Texas, you may be familiar with this, or if you're in the coastline, you may have that. In other states, you may just have a regular deductible. It just depends. How the deductible works is deductibles are going to be the first thing that you're going to pay out before the insurance pays out. So in this example, if there's a total loss, you're going to pay the first $1,000, the insurance will pay the rest. Next, hurricane deductible. In this example, it's $5,000. So before the insurance pays out, you pay the first $5,000, and then they pay the rest. Again, my name is Jamie.